COBT listeners and viewers. It's Maynard and Mike with special guest host Deborah Byers. And we're really excited today to talk to Jim Bride. He's the president of Energy Tariff Experts. His firm recently did some work for EPSA, the Electric Power Supply Association. And it really gets to what everybody's talking about, which is power prices, the components of power prices, which pieces have been going up, which pieces have been holding steady. It's a really great diagnosis. It's a PJM focused study, but I'm sure it has applicability more broadly. Let me stop talking and just say, Jim, we're delighted to have you and can't wait to talk about the report with you.
Oh, thank you. Thank you for having me.
And Jim is joining from Boston, where it's a sunny day. And, it's kind of like, let there be light on these power prices, and you're going to bring some light. So we really appreciate it.
Oh, thank you. And if it's, so it is Boston in November, so the sun's going to be down in about an hour and 20 minutes. So, if I was a solar panel, I'd have another hour and a half or so of useful life, and then I'm done.
This sounds like a Barbara Walters question. Like, if you were a solar panel, what kind of solar panel would you be? All right. Jim, thank you. Before we jump in, Mike, the markets have been jumping around a little bit lately. What would you tell us, sir?
I don't know if I can really follow that up.
Well, if you were a windmill or perhaps a drilling rig, what kind of drilling rig would you be?
Well, right now I'd be a broken drilling rig.
Okay, you're a broken drilling. You're a rig with no. Well, I don't know. Well, these.
Yeah, I mean, a rig with no power right now. If you look at the Dow today, the Dow's down anywhere from 200 to 400 points today. Yesterday it was down anywhere from 400 to 600 points, and so you would probably say the markets are a bit wobbly. And I think the reason they're wobbly is because interest rate concerns are starting to develop, and you also have AI stock exhaustion. And you also have an overall equity market that most are saying is a bit overpriced. And so you've got those three things working against you. And that's not too different than what we've seen over the last couple of weeks and months. I mean, that's been a thing we've heard out there. Now, as far as the interest rate issue, I mean, the 10-year bond yield's around 4.1%. It's inched up here over the last few weeks. We're now going to start getting economic data from the U.S. government. We haven't gotten that, so that can be good and that can be bad because we're just getting data, so who knows what it's going to look like. But I think what's hurting the market right now is that it looks like some of the Fed governors are starting to kind of flake out a little bit. It looked like most of the market was assuming we were going to have an interest rate cut in December at the FOMC meeting. Odds were like 75 to 80%. A couple of weeks ago that was going to happen. They're probably down to 45 to 50% that we're going to have a rate cut. So that's really kind of been hanging over the markets. The other thing I would say is if you look at Bitcoin, we haven't talked about Bitcoin, I don't know, in about a year or something like that. Bitcoin has gone from like 125,000 down to 90,000 here in the last month. And so that obviously looks like a risk-off trade. You can kind of see there's a reoccurring theme going here in markets. From a broader equity standpoint, the S&P is down about 3% over the last 5 trading days. Down about 4.5% over the last month, over the last few weeks, I guess, from recent highs. And so, we talked about a couple of weeks ago that the S&P looked like it was losing some trading momentum, and it has, and it is. And so if you look at sort of these big AI tech stocks that have been leading the market, they're down about 11% from their highs. This is the most technically oversold, or getting the most technically oversold since the April tariff scare that we had. So that doesn't mean these stocks are bottoming now. That doesn't mean they can't go further. It just means technically you're starting to get towards oversold territories. And we haven't seen that for quite a bit of time. I'd say if we start to think about this week, tomorrow is a big day, right? NVIDIA is going to report their Q3 results. Obviously, the market is going to move on that, being the largest market cap company in the S&P as well as the world. And so it's going to be really important. But if you look over the last 2 or 3 years, this company beats every quarter. It just beats every quarter. It feels like GE back in the sort of 90s and 2000 era, right? The issue is those beats were followed by the stock moving well. Recently, those beats have not been, followed by the market, stock doing well. It's been kind of mixed, to be quite honest with you. So it's going to be really important tomorrow that they have a really good story to tell, because the market's going to be moving on the back of those earnings. As far as the oil market's concerned, we've talked about this quite a bit. Oil's kind of stuck around $60 a barrel. And we saw last week the IEA came out. They did about face on what they think that intermediate long-term growth is going to be. You know, they were talking about 2030, oil is going to plateau or maybe even decline. And now they're talking about 13% growth out to 2050. So that's one thing. The second thing we note is the IEA also talked about this oil surplus, right? They actually increased the oil surplus in Q1 of 2026 to 4 million barrels a day. That is totally ludicrous. That's not going to happen. It's probably closer to 1 million barrels a day or thereabouts. The issue is it's still an oversupply, which means prices are going to be capped here probably for the next 60, 90 days or so. You know, the last thing we want to really talk about, since we're going to talk to our guest about electricity, is maybe, you know, just talk about these electricity stocks. I mean, they've been some of the best performing stocks. You know, we've labeled these companies growth stocks. We continue to think they'll be growth stocks over the next 3 to 5 years. But like the equity, you know, overall equity market, they've kind of pulled back here. You know, if you look at electric utilities over the last month, they're down about 3%. IPPs are down about 11%. SMRs were the hottest, place in the market. They're down about 40% over the last month. You know, so bottom line, the electric utilities have already given their 3 to 4 year outlooks on their Q3 calls and at the EEI conference. And so you got a bit of a void there in just news flow. And so I think they're going to act kind of like the market. So bottom line, Maynard, 2025 has been a great year for equities. You had the S&P 500 up 13%. You have tech up 20%, 21%. Electric utilities are up 18%. And so it just kind of feels to us and looks like to us that the market's losing some trading momentum. People are taking some profits off the table as we head into year end. So that's the state of the market, Maynard. So back to you.
Awesome. That was a great review. Well, Jim, we're just going to jump in right away, if you don't mind. I asked Deborah if she wanted to say anything in the upfront. She said, no, let's get straight to this report. This is good stuff.
Although I'll say, since we were picking what type of energy item we are, I'll be a nuclear plant.
Oh, that's great.
Any brand or no, you don't have to go there.
No, I don't want to go there.
Low carbon base load.
See, Jim, you've set off a whole new trend here, and not just power analytics, but power humor. Well, seriously, let's jump in. I think, power prices, it's just been building for a while now, and it seems to be getting more and more on people's radar, and particularly in PJM. It was in the New Jersey governor's race as to why power prices are what they are. Governor Shapiro makes noise about, are they going to pull out of PJM? Are they, what should they do? So there's a lot going on there. You're in Boston. And so you know a lot more about so many things, but particularly the Northeast attitudes on power. Maybe to kick us off, we can start wherever you like, but if you kind of preview your analysis, I think everybody would appreciate it. And the only thing I'd say, Jim, having read it, if you will be painfully simplistic in your discussion, I think that'll help everybody, because there's a lot of terminology and lingo and so on and so forth. So I just want to make sure you've got great work, and we just want to make sure that everybody really absorbs it.
Oh, thank you for that. Yeah, maybe before I even frame the issue, it might be helpful just to explain our firm. So our firm name, we're pretty wonky. It's Energy Tariff Experts, and the tariff is the rate book. And so you hear people talk about whether it's the open access tariff for a place like PJM, a competitive market, or a retail tariff. The tariff is the rules and regulations and rates for how how energy is managed or billed. And so our focus is really retail rates, and whether that's for electric vehicle charging, residential consumers, large industrials, anything that deals with rates or rate making is kind of in our world. So for this report, I think it's important to kind of frame how we got here. And so you may hear people talk about PJM or New York ISO or ERCOT or whatever as a deregulated market. But they're not really deregulated. They're just regulated differently than vertically integrated markets that were the norm up until industry restructuring. And so what happened basically is up through the 90s, you had vertically integrated utilities where the utility had the wires, the the distribution wires, transmission and generation. And there was some sharing amongst utilities, but it was very much a siloed business by utility. And what happened in the 90s, really beginning, I guess, in the 80s, is the push towards, the term is deregulation, but really industry restructuring, because the only true monopoly function of a utility is the wires, the local distribution franchise. And so the industry was essentially broken up into three major segments: local distribution, transmission, and generation. And part of restructuring was to create a competitive market for generation. So you mentioned before independent power producers. So in a place like PJM, most of the utilities are what are called wires-only utilities, where the distribution utility has the local distribution wires. Most of them have a transmission entity that maintains FERC jurisdictional long-distance transmission lines. And then there's a robust competitive market where independent power producers, or what might be called merchant generators, own power plants, and they compete in the PJM market for the there's a daily auction, essentially, where they make bids based on their cost to generate to supply power to the market. And then PJM, dispatches power plants based on their cost to generate and whether their bids clear. And so you have this highly competitive market that selects generators based on their characteristics and price. And so the idea with restructuring was that utilities tend to, in the 90s and before that, they had struggled to operate their plants efficiently. And one of the big catalysts was actually talking about nuclear, was regulated utilities with a right to earn a profit enshrined in law having to declare bankruptcy because of cost overruns on nuclear power plants. So this is going back to the 70s and 80s, where there was a real rethinking of, who should be bearing the risk for operating these plants? Should it be ratepayers or should it be investors in the marketplace? And so the way we got to where we are in PJM now was a restructuring of the industry. So in the late 90s, early 2000s, the utilities that owned power plants divested them, and they were purchased by independent power producers. And there was also a rush to build new capacity in that era. And so you had a ton of investors coming into the market to invest capital to refurbish or upgrade existing utility assets that were divested, or to build new. And so when you look at your bills in PJM, you really have 3 and maybe 4 buckets of costs. There's the generation charge, which pays for this competitive market that I just discussed. The distribution charges, which pay for the local distribution wires. Transmission charges, which are typically separately identified and pay for the long-distance transmission system. And then the other bucket would be public policy charges, so renewable portfolio standards, green programs, energy efficiency, and that sort of thing.
Jim, can I ask you a question, which is, so yes, those are the components of your bill, but will you just tell us, people literally getting their bill in Maryland, Pennsylvania, New Jersey, Ohio, can they literally see, how well can they see some of those charges?
It's a great question, and it really depends on the state and the bill format. So in some places, all the charges are separately enumerated. And in some cases, some of them are bundled together. The one thing that everybody can see is generation versus distribution and transmission. So in not all of PJM, but most of PJM, there's retail competitive supply. So you, even as a residential customer, could go to a third-party energy supplier like Constellation or NRG or someone like that, and go get a competitive quote or for the generation part of your bill. So in most states, there's what's called standard offer service or default service, but there's a default supply option for people who don't choose a competitive supplier to take, and most residential customers are on that. But you could do a competitive contract, and something like 85% of all commercial customers have competitive supply. And it was modeled sort of after the idea from telecom, where the local monopoly is the wires, but you could get long distance service, at the retail level competitively, and that's just, retail energy works similarly.
And so I mentioned this in the upfront, but do you mind giving us the history of kind of how EPSA approached you and said, let's do this study, and like what was the background? That would be great.
Great question. I think, and also for framing, so EPSA is a trade group who represents competitive power generators. So there's, large independent power producers who own many plants. There's some small investor groups that might just own a couple plants. And there's a wide variety of generation technologies represented there. And so EPSA's members, are competitively producing power in the PJM market. And the PJM market is, has evolved over the last 20 so years of restructuring, and its rules and regulations are guided by FERC, the Federal Energy Regulatory Commission. And so they reached out to us basically to help frame what the change in capacity prices that occurred in June 2025, what does that mean for retail customers? And the reason they reached out is because if you ever seen a Rube Goldberg machine with all sorts of different transmission mechanisms for the marble to go down the hill through all the different obstacles, utility rate making can be kind of like that, because when you get to your retail bill, there's a ton of different components. There's regulatory lags. There's different ways of coming up with the going through the rate making process. And so the reason EPSA hired us is they wanted to basically put it in consumer terms what the change in capacity prices mean, and be able to frame for an average residential customer, what are they going to see in their bill? And so that was really the reason for the study was to put it in dollar terms for a typical residential customer.
No, that's great. Talk to us about your findings. And if you don't mind, also the process by which you did all this work, because it's a lot of detailed work. And I think just understanding all the labor that went into it would be helpful too.
Yeah, why don't we start there with how we actually did it? And so, so we, as part of our day-to-day operations as a business, we're grabbing utility tariffs and we're processing the information. And so in some utilities, we had a lot of the data already. In others, we had to go, I call it regulatory archaeology, going through some of the commission websites and dockets to find filings that might have been 12, 13 years old. But we basically assembled a complete time series of every single rate component for the utilities in the study going back to January 2014. And so...
And how long did this take, Jim?
I have to go check our timesheets. It took longer than we thought it would. But
I mean, we're talking months.
Yeah, it was a good deal of work. Because I think the other thing we had to do is, there's different things kind of baked into certain rates. And so so we found all of the different what are called base rates, which is the utilities rate for distribution. But then there are these things called riders that are single item cost recovery items. And so Ohio is famous for having dozens of riders for smart meters, and for every single program, there's they've kind of proliferated over the years. So in order to get the entire rate and kind of forensically reconstitute it for a typical customer, we went through utility work papers to figure out what's a typical residential customer, how much energy do they use in a year, and what's the pattern, because the seasonality is also really important as to what does a standard customer look like? And it's all over the place. So a great example would be in PSE&G in New Jersey. It's a very urbanized and dense service area. The typical customer there uses less than 7,000 kilowatt hours a year. Because of the housing stock tends to be more apartments and townhouses. And then there's other utilities, say in PPL, in northeastern Pennsylvania, the average customer uses almost 11,000 kilowatt hours a year. There's also a fair amount of electric heat in that area. So depending on the housing stock, how they heat their homes, how they use energy, there's some really, I think, differences in the customer types that you see in the residential group. So we benchmark who the average residential customer is, because people tend to think it's more tangible to talk in total dollars than unit costs. We reconstituted every component of the bill, and we took utility tariff sheet revision numbers. So we had a daisy chain, revision 1 through revision 100. And then we also, in some cases, there were imputed values where we had to disaggregate things that are included sort of within a charge. Say the generation charge. We had to disaggregate how much is capacity and how much is energy.
Can I just ask you, Jim, just a really dumb question? You're having to do all this forensic work. If you had just, does it imply you can't just go to these utilities and all these participants and say, can you please give me your numbers? You had to reconstruct it in a weird way.
Well, to go back 12 years. So I think if you went right now to the utility website, depending on the utility, there may be some helper sheets or brochures that might explain some of the rate components. But to get a total disaggregation into its components, there's the tariff basically. And so a typical utility tariff might be 100, 200 pages, and it will have all of these different charges that sort of all kind of come together. It's sort of like, putting a puzzle together as to the distribution rate, the riders, the extra charges, the public programs. And so we essentially assembled it because we wanted to be able to disaggregate the bills into their components to find some of the trends that we're seeing.
You mentioned you have to kind of look at the mix, right, of the residential density, whether it's single family residences or it's apartments. I think that all makes sense. You also mentioned heat, and did you disaggregate or kind of take out that noise? Where is there an increasing trend in electric heat versus gas, and then population? I assume you kind of have to normalize that to get to you're pinpointing what's causing the rise in prices or which component is. And I also kind of hear in the background, some of these additional costs are things like system, just digital upgrades, right? Smart meters to get more efficiency out of services, customer, front-end customer services as well. Those would all be embedded in that rate making.
Exactly. And what we did was we held usage steady because we didn't want to have two moving variables. So what we did is we basically looked anywhere from 2021 to present. So we had either a 2 to 4 year window to get a sense of what's the average customer. And you might get a hot year or a cold year. So we were trying to get sort of, either weather normalized usage or just average usage for a typical customer. And then we said, okay, well, if this typical customer today, what would they have paid in their bill going back to January 2014? And how has the bill changed? And what's interesting, you mentioned smart meters. One of the findings that we found is that distribution rates, generally speaking, have been fairly flat when adjusted for inflation. And that it's, in most cases, distribution hasn't been the biggest driver of increases. The interesting part was that the transmission part of the bill has been the biggest cost wedge in many utilities, consuming a greater share of the bill than it did 10, 12 years ago.
So while we're right there on that punchline, Jim, you mentioned these 4 buckets: generation, transmission, distribution, and then sort of this other, which is mandates and riders and things like that. Do you mind just giving us which of those buckets are the problem? What's making power prices go up?
Sure. Well, transmission has been a very, very interesting thing because the way transmission works is that it's regulated by FERC and not the individual states. And so the utilities that own the local distribution utilities, they typically have an affiliate company that's called the Transco, or the transmission company, that owns the transmission assets. So if you're driving through PJM and you see the wires on the poles, well, that's the distribution rate base. But if you see a high voltage transmission line, that would be in the rate base of the transmission operator. And so a lot of them have moved over the last decade or so or more to what are called formula rates. And so formula rates basically is a FERC-approved formula where you have inputs and outputs. So you input all the capital expenditures, the rate of return, and the operations and maintenance, and what your property tax bills are, and all the stuff goes in, and out comes a rate. And so what you mentioned earlier in the preamble, you talked about utilities as growth stocks. And what's been really interesting is watching transmission as being the way that utilities have been able to deliver growth. Because the way the transmission business works is you invest capital and you get a return on that capital. And so there's been this, and there's also a need for more transmission to a degree too, because you need to be able to move power efficiently through the grid. But like if you were to look at the Ohio graphic, these are 5 utilities in Ohio that we looked at. So there's 2 AEP affiliates and then 3 First Energy affiliates. And what you can see here, these are all of the non-generation charges. So this is wires distribution, which is blue, transmission, which is gray, and then public policy charges and taxes are sort of the orange here. And so what's interesting is if you look at, in particular, AEP, you see this gray wedge here getting bigger and bigger. You can see that distribution rates, and really in all these utilities for local distribution have been flat to even falling to somewhat to a degree. And then you see transmission eating up a bigger share of the bill. And so across the Ohio utilities we looked at, that's a pretty consistent trend. So in Pennsylvania, you see that it's not necessarily every single utility, but what you can see is that PPL, you can see that transmission is a much bigger part of the bill in 2025 than it was in 2014. And then you can see it's sort of a mixed bag from some of the other utilities. Some of them, transmission's growing, but not nearly at as fast a clip. And then if we look at New Jersey, if we put the two utilities we studied in New Jersey side by side, you can see that PSE&G transmission has grown tremendously as a part of the bill relative to distribution. But then JCP&L, it's been pretty stable. And so 2 utilities in the same state right next to each other have a very different profile as to what their transmission charges are. And the driver there is really the transmission rate base. So PSE&G or AEP and PPL have invested a tremendous amount of money in their transmission plant. And by growing the amount of invested capital and rate base, their transmission rates have gone up. And then transmission rates basically flow into the retail bill through a state rate making process. And so so if you think about the 4 different buckets of charges all kind of competing for space on the bill, transmission has grown significantly, and across the board, local wires distribution service on an inflation adjusted basis has been constant or declining in some spots.
Hey, Jim, so you've got all this data, which I think is really interesting, and maybe you address it elsewhere, but so you have these 2 that are in the same, regulatory regime, and they have a little bit of a different profile in what's driving the bill. But how is that correlated to sort of where the supply is coming from, where the generation is, or the mix of generation, as well as now if you compare different regions where the policy driver is? I think that's because to say that, they're making a transmission investment decision at the company level for a specific reason, certainly, yes, to get, growth, and that's driving that growth, that seems like an outcome, but there is an investment decision behind that for what they want to deliver to the customer in terms of the end, electrons that customers want.
You're just saying if I'm choosing to deliver, if my generation source is farther away, I have a higher transmission
exactly
cost, and that's how it's showing up.
So I think that correlation of where they're tapping into, or maybe they're just buying in the wholesale market. I don't know how that is working, but
no, that's a great question, I think. And actually, here, I'll share again in a second, but let me answer that, because I think one of the things that, and this is a real, I think, public policy issue that you're highlighting is, if you were to go back 15 years ago, there was a tremendous amount of congestion in the PJM grid, where you had, cheaper power in the western part of PJM and much more expensive power, and you couldn't necessarily transmit power across it. So if you were trading power or an end user trying to buy power, congestion risk. And so congestion would basically be the price spread between point A and B, and that the cheap power can't flow to where the load needs it. And so there's been so much transmission investment that congestion has been reduced substantially. And so power can flow much more freely through the grid. And so that's a very good thing. Then the question becomes, well, what's the right amount of transmission, and what's the optimal amount for the grid, the health of the grid, and the functioning of markets? And so this is where you're starting to see kind of a collision course between the utilities that want to build more transmission to grow their rate base, the PJM planning process for how transmission projects get approved and move through the process, and also state regulators who are concerned about affordability and what's the right amount of transmission, and how do we make sure that we're spending the money in the right place. So FERC Order 1920 actually gets at the transmission planning process to try to have a way for state officials and state regulators to have more say in how that is, how that's done. Because being a FERC regulated, there's a lot of efficiencies through a FERC regulated multi-state market, but then I think the trade-off then is, well, how do you make sure that state officials have a seat at the table for transmission planning? So I think that's one thing, is you have the benefits to the market with more efficient flow of power. But then the upside, the other side of the coin is, well, now we've got new technologies like storage. Is storage a way to manage a transmission bottleneck where you can store power and save it for later discharge when the bottleneck might not be there? Or there are other technologies like dynamic line rating that might be another solution. So I think even within transmission, that there's questions that more transmission is good up to a certain point, and then there becomes some real affordability trade-offs and maybe other technologies that might be more effective.
So maybe, and Mike, you've got to get in here. I just, this is a great conversation, because just when I thought I understood your analysis, I'm confused. So here's my confession. You said in the upfront, rising costs in most utility service areas studied can be attributed to increasing transmission charges, and particularly in New Jersey and Maryland, public policy related charges have grown at rates exceeding inflation. So I think we all understand, okay, those two states have been layering on a lot of governmental mandates, and that's a cost thing. We get that one. But then I think the reader is tempted to say, okay, and we hear this, it's not generation that is going up that is causing rates to go up. It is, as you said, transmission and then these public policy charges. But if the transmission in it, if it has charges related to the choice of generation, you can't really separate them like that. And so I think that's what we were trying to do, Jim. We came into this study thinking you were concluding it doesn't matter if you have wind or solar or gas or coal, the real fight is about these other things, but actually those other things may reflect your choice of generation.
System. So it's integrated, and one affects the other, and it starts to come back to policy choice.
So what do you think, Jim? What's been the takeaway from this report? What is the takeaway from this report? I thought for a minute here we were going to dodge the whole battle about generation sources and what's cheaper, but I think we're back in it.
Well, yeah, and I think it'd be a great time to talk about fracking in a moment, because that's a big part of the story. Is that, I think really the story is that there's a lot of moving pieces, and so to say, oh, your bill went up because of one thing, there's much more nuance to that, and so I think that, yes, generation capacity prices did go up in June of 2025, and I'm going to come back to that again in a minute. But you also have, we had an era really that may never be replicated again. If you look at the executive summary of the report, I've just got the slide up now that shows, so to normalize across utilities, we just are showing unit costs here. What is the unit cost of generation energy and capacity? Because the way PJM set themselves up with their generation market is that generation is a two-part product. There's the energy for when you need energy. You flip on the light and the power flows and it's there. But then the capacity is a separate product because you want there always to be enough power to meet load. And so PJM is different from, say, ERCOT, where it's an energy-only market, where the energy price has to be enough to sustain new investment. Where in PJM, the concern is that, well, you have low load months like May and October, where there's power plants that are going to be dormant. But when it's really hot in August or it's really cold in January, you want to make sure there's enough capacity there to turn on. And there might be, whether it's demand response or peaking power plants or increasingly batteries, there has to be something there to serve that load when it's peaking. And so, but so that generation product really has two components. So they're bundled together. And so what we did in this chart here is we showed, okay, on a unit cost basis and adjusted for inflation, what has generation cost the residential consumer in total and by component? And so what you can see across this broad basket of utilities throughout PJM is that we were in a declining price environment from 2014 through about 2021 across the board. And it was an environment where you had the shale gas revolution. So all of a sudden, natural gas fundamentally changed power grids because you had coal plants that historically had been base loaded. And all of a sudden, when natural gas is $3 or cheaper, natural gas is cheaper than coal. And you also had a situation where, talking about nuclear plants went from being base loaded to, whoa, natural gas is now cheaper than nukes. So it caused a tremendous amount of I think disruption, but for consumers, there was a tremendous benefit because you can see consistently falling generation prices. Mm-hmm. Our chart starts in 2014, but if you were to go back all the way to 2008, it's really a pattern of falling prices and stagnant load growth. So we had this era of going from overcapacity in PJM to, many years of plant closures, primarily coal and some nuclear plants closed, and flat to declining load growth. And so consumers really benefited from the way the competitive markets interacted with gas plants, basically, new combined cycles being built and that savings in fuel costs being passed on to consumers through the generation part of their electric bill. And then the Ukraine war happened. Natural gas got pretty expensive, and you can see, say, in PPL, you see this clearly in 2022, the prices go up. And you also see it pretty clearly in Ohio, 2022 to 2023, the prices all of a sudden, we snap out of that declining cost curve and things get expensive again. So depending on how your utility procures its default service supply, we really flipped from declining prices and flat loads to rising prices anywhere from 2022 to this year. And also the relative contribution to that generation charge of energy and capacity also shifted. So having the historical perspective, adjusted for inflation, 2025, even with the higher capacity prices, isn't really that expensive in historical context. It's just that on a recency bias, it's a jump because capacity prices went up, but generation in total is not that much more expensive or expensive. It's less expensive in many cases than it was 12 years ago.
So if you're the consumer in all this, I'll just take your last three bars, 23, 24, 25. I get this spike, or I read in the paper there's a spike associated with the generation charge. And your point is, yes, it was up a lot over 25, was up a lot over 24 and 23. But as a percent of the two together, we're not out of the norm. on this generation charge. But meanwhile, if I'm a consumer, this transmission thing has been ticking up. And you point out the government's been layering on some more costs. So this gets really, this is what we've been talking about here, the finger pointing about why power prices are going up. It's getting confusing.
Yeah, and there was a natural sort of economic, within the market, just an economic development, which was you had very low feedstock, natural gas, because of the shale revolution. It came to the market. It may generate, you're trying to deliver cheap generation to the consumer. So you're retiring coal. And so there is a spike, but over time, it's still net a benefit to the consumer to have low natural gas prices as a result of, all the gas that's come onto the market.
Mike, we got to get you in here. You're the price at the plug. Jim, Mike likes to say price at the pump has been replaced by price at the plug for
I like it.
Consumers.
Yeah, Jim, I thought the study was pretty interesting. I mean, I think you laid out around 45% of the cost is generation. And I think most people, because they talk about the PJM capacity auction, they're talking about natural gas generation going up, costing it. And so everyone assumes or presumes that all the cost is the generation part, not the other 55% part, which is really interesting. Maybe the question I have is the other 55%, you obviously said it was transmission and distribution. Maybe if you can break down the transmission and distribution, it seems to me like the last mile is where all the costs are, right? Where a lot of stuff can get put into the rate base. And it seems to me that over time, if we identify the big issue is the transmission and distribution side, it would say over time that either ROEs are heading lower. These utility commissioners are going to say you're getting too much money, or B, they're going to say, we're going to allow you to get the same ROEs. But if you take out costs out of the system, you're going to be able to keep 20% of that over the next 2 or 3 years. And that's how you lower costs. Maybe some thoughts on that, if that's the solution.
It could be. I mean, what you're describing really is, performance-based rate making in a sense, where utilities in general, and if you look at a lot of the different players who are building transmission assets in PJM, in their investor presentations, they talk about the transmission rate base and the fact that ROEs for FERC transmission assets tend to be a little bit higher than what they can get at the state level. So if you're just thinking on an ROE basis, it's more attractive to direct capital there than in your state regulated local distribution plant. And so I think some type of the consumer. If you look at the growth rate in different parts of the bill, whether it's public policy charges or transmission, they can't keep growing at, high single digit CAGRs for forever. At some point, you're going to run into, and we're seeing this now, affordability constraints. And so how do you get more out of the assets you have? And so I think some sort of performance-based rate making construct, and I think assuming FERC Order 1920 is successful, seeing more state consultation involvement in the transmission planning process, that's something that potentially could come out of it. It's hard to say, but.
Yeah, maybe the other thing, just follow on there. I think cost of living is also an issue by region, right? And I guess my question is, if you were going to do this study, with other RTOs, are we going to come to the same conclusion? Is it the same conclusion where, sort of the last mile, transmission is where all the costs are, say for ERCOT, whatever the case may be? Is that the conclusion?
No, each one is kind of its own animal. You've got California and New York ISO, which are single state RTOs. So that I know I say RTO, Regional Transmission Organization, is kind of and then ERCOT is also kind of its own animal because it's within Texas and it not FERC regulated. And so it seems kind of cliched, but each one really is different. And then, MISO and SPP, they're regional transmission organizations, but it's really, utilities own a lot of the generation there. And so I think if I was to think about, say, ISO New England, where we are, at the wholesale level, we're defined very much by a winter pipeline bottleneck for all sorts of reasons, we can't get enough gas into New England on peak winter days. And so things inverted where we have a very strong winter peak in terms of pricing. Where PJM historically 15 years ago would have been very much a summer peak. Now you've got a winter and a summer peaking concern. But it's not quite as pronounced. So I think the other thing that flipped, we were talking before about being, in a 15-year era of flat loads. Well, all of a sudden now the load forecasts have changed like dramatically. And so, really it's almost like a whiplash looking at it. And I wouldn't want to be the guy at PJM who's making the load forecast, because no matter what you do, you're going to be wrong. But we know at least the direction of the load is now trending up. And the question is how fast and how quickly. But we were in this period of attrition from the market with coal assets and older nuke plants closing and dirty fossil peakers closing. And now all of a sudden we need to add more capacity. And that's really why the capacity market, really like why we're here, is the price tightened because there's a need for more capacity to meet those peak load forecasts several years out. And so the idea with the capacity price that consumers pay is that that's a price signal to investors to say, hey, come build some more capacity here. And it doesn't have to be a traditional generation plant. It could be load response. There's industrial customers who try to manage their capacity prices by gaming when the peaks are. So you're going to activate all sorts of different types of capacity, or maybe attract batteries or storage assets or other, newer entrants that can meet that peak need. But that's the whole point of it, is to say, hey, we've got a price signal that shows that we have a scarcity condition and we need more supply to enter the market.
One last kind of thing, because I know we've got a lot of variables. We're kind of back to, hey, why did the price rise? But shouldn't we also acknowledge the grid is old? And so there's a big component of this that has nothing to do with new capacity or new demand, et cetera. It really has to do with the fact that, we've built this grid over 200 years. Distribution and transmission assets are some of the oldest assets on the grid. And so you just have a basic need. It's a public good to make that investment. It's necessary in order for it to continue to deliver. So it'd be interesting to see how much of that replacement, and that's going to be very different across the country.
So, but that's a great point, because I'd say, so my parents, they live in the house in New Jersey. They bought in 1979, and across the street is a PSEG transmission power line, and it was a lattice tower structure that was built in the 1920s, and so these towers are almost 100 years old. And so they had to replace them because they were really old, and they needed to upgrade them to a higher voltage and higher carrying capacity. And so I think there's two things. There's building new assets to debottleneck the grid, but then there's also assets that are obsolete. And obviously when you replace things with things that are new, you've got more rate base and you have to depreciate them. And I think the other thing, the same goes in the generation market. If you have a 40-year-old power plant that's basically recovered all of its capital costs and just needs to sustain itself, that'll have a much lower cost to operate than a new build. And so one of the factors in the capacity market in PJM is this thing called CONE. What's the cost of new entry? A new build power plant somewhere on the grid where its power can be delivered to the market. And when you need to build new stuff, it costs money.
So Jim, could you try to answer this? Transmission bucket just gets more and more mysterious, right? Because one of the things you said is there's a FERC formula. And so one reason why the rates might be going up is it's just easier to work the formula up. That's one reason it's easier to do. Another one is it might be your choice of generation, therefore you need more transmission. So that was an interesting one. Another one is Deborah's point is aging and physical infrastructure, and it's costing more. And another one is people are choosing to build more for some of those balancing reasons. And then there's this bucket we've been talking about, which is these throw-in charges that somebody's adding with a waiver or something. I think that's in that bucket. So it's like defying our ability to say, okay, yes, transmission is going up, but there's so many things in the bucket, it's not really one flavor. Is that fair?
Yeah, well, I mean, I think that at a very high level, if we were to just think about what's in the bucket, we've got some let me show a stacked column chart for one of our state analyses. Here, let's pick this.
We may have to call this show "What's in the Bucket," Jim.
Yeah, there's
welcome to What's in the Bucket.
No, and I think one of the tough things too is making sure I'm not just going so deep into industry jargon. Okay, so this is Pennsylvania.
Okay.
And so what I'm showing here, this chart here is from 0 to 100% of the bill. What are the different components? Okay. And so generation and capacity. So energy and capacity are the yellow here. So you can see, if you think about like who's taking up space on the bill on a percentage basis. And if you think about the different buckets, distribution, transmission, public policy charges, and generation, all four of those are fighting for space on the bill. Mm-hmm. And so you can see the generation was kind of trending down in each of these until right around 2022 or so, when it started to nudge up. And just for the sake of not having too many colors, we group distribution and transmission together. And you can see that they are taking an increasing share of the bill. And part of that is that generation prices went down to free up some space on the bill. And then you have Pennsylvania's renewable portfolio standard and public policy charges are fairly moderate. So you can see the blue there is getting to maybe 10% of the bill is public policy type charges. So those are all kind of your dollar, where the different pieces are going. And then if we were to look at New Jersey,
and Jim, do you mind just telling us, like, plus or minus, what are power prices for consumers in Pennsylvania right now?
So it's about the high teens, basically. So if we were to look at, so if we're to talk about the total bill, let's say we look at PPL, the total bill here would be about $116 or so for the distribution, transmission, public policy components. And then the generation component would be about $75 to $78. So in total, you're looking at just under $200 a month or so of total cost for the average customer in 2025.
Okay, and do you mind doing this? Let's why don't we pick Maryland or New Jersey, whichever one you want to pick. Let's look at the same graphs and give us the same numbers for another state.
Sure. So New Jersey, if we look, and I think I'm glad you mentioned New Jersey. One of the interesting things here in New Jersey, if we're going to talk about the average bill in dollars.
And you said this is normalized by use, right?
That's what exactly. So PSE&G, on a dollar basis, it's going to look a little bit better than on a unit cost basis, because you'll see that PSE&G, if you look at the average monthly consumption, both PSE&G and JCP&L, they both peak in the summertime, but JCP&L tends to have bigger houses and more electric use. And you can see the air conditioning summer peak there is a bit stronger than what you see in PSE&G. So if we were to look at the total bill, the stuff that is non-commodity, so despite having lower usage, the average PSE&G customer pays a little bit more than JCP&L, with the JCP&L bill being, it's just over $80, so about $87 a month for transmission, distribution, public policy. The PSE&G bill being a little bit over $90. And then if we look at the supply components for PSE&G, we're right around, on average, again, this average is in April and August, so it's just an average bill. It's about $50 in PSE&G, and about 75 or so in JCP&L. So if we were to add those two together, see 75 plus, so it's about a little under 160 in JCP&L, and then this is about 140 or so to total bill in PSE&G, and so and that's basically adding the stuff that's not generation to generation together.
So, Jim, does that number you just had, the 140 or the 160, that compares to the 200 in Pennsylvania?
Yeah, and again, it's a function of PPL customers tend to use more electricity. So I think if we talk in total dollars, it's also a function of how much customers use. If you were to look at PPL, you can see that compared to the other utilities, they have more winter use. So what's kind of interesting is that winter use in PPL is actually higher than summer use for average customers. And so part of that total dollar in the customer's bill is a function of how much, kilowatt hours they consume typically.
But just so we make sure we understand, if we're not talking total average bill, if we're just trying to understand cost of power on average in Pennsylvania for a retail customer versus cost of power on average for a retail customer in New Jersey, what are those two numbers?
Oh, sure. If we were to talk about retail generation, the average monthly capacity and unit cost per generation, say for PPL for 2015, it's just under about 8 cents a kilowatt hour, where in PSE&G it would be around 9 cents a kilowatt hour or so. Okay. And then the remaining T&D charges would be 11 to 12 cents. So you're right around 20 cents a kilowatt hour, give or take. And PSE&G might be a little bit more, they might be the low 20 cents a kilowatt hour range. But in terms of what on a unit cost basis, if generation's a little bit under half the bill and you're at just shy of 8 cents in PPL and around 9.5 in PSEG, when you load in, we didn't make a graph that actually shows kind of the bill in total for all components, but it would be in the low 20 cent range in PSEG and the high teens in PPL.
So a few cents more a kilowatt hour in New Jersey than in Pennsylvania.
That's accurate.
And the other thing about that New Jersey graph, it had that, and I guess it was compared to the Pennsylvania graph, that public policy bar looked really big.
It's big, yeah.
And you just wonder why they just went through an election, and I don't know that this was exactly the dynamic, but you're surprised people don't just say, yeah, we know power prices are up. We're just going to cut that. We're going to cut that orange bar because that's what we're choosing to do to ourselves. Is that fair? Is that what comes up? Can you explain the orange bar a little bit to us?
Yeah, the orange bar. So of our study, Maryland and New Jersey have the biggest orange bar here for public policy charges. And this is something we're seeing throughout states where they had very, very aggressive decarbonization policies grounded in, we know that climate change is a serious threat, that there needs to be a public policy response to it. And the question is, well, what's the best way to do that? And so there's been an enormous, I think, variety of strategies among different states and how they're going to pursue their decarbonization policies. Are they going to promote specific technologies or what have you? And so what you see in here basically is all of the items that were deemed public policy charges along with the renewable portfolio standard. So New Jersey has regular renewable energy credits, solar SRECs, green programs charges on the bill. And so what we did here in the state appendix is we explained what those charges are. And so for public policy charges, we were looking at, the RPS, the renewable portfolio standard, the anything that basically fell into the public policy bucket, like energy efficiency charges. And so there's kind of a proliferation of different charge types, but they all basically were based on some sort of policy or mandate. And so what's happening now, though, is that in an era of declining gas prices and declining generation prices, there's space on the bill to have those programs and not really cause affordability problems. And so what we're seeing now is a confluence of generation prices reverting back closer to the historical trend with load growth and higher capacity rates, transmission, which is increasingly taking up a larger percentage of the bill in some of these utilities, and and the question is, are these public policy programs affordable and are they right-sized for their effectiveness in decarbonization? So I think that in New Jersey, Maryland, and a lot of other states, there's some hard conversations happening now about these programs and how cost-effective they are.
So do you mind in New Jersey? So we mentioned it's maybe 3 cents a kilowatt hour more than Pennsylvania, just to stick with that comparison. How much are these public policy charges in New Jersey per kilowatt hour? Would that eliminate the difference between the two states?
I have to go pull up one of our spreadsheets. Actually, if you're willing to wait a sec, I could actually pull up a sheet and show you everything that's in it. But
sure.
I don't think that the public policy charges on their own would explain the entirety.
Or I'm just saying they might make up the whole difference. Yeah.
Oh yeah, no, it's a big component of it. Yeah, so hang with me for a second. I will pull up an actual spreadsheet to show you what we did. So if we're in PSE&G and we're looking at, this could be, I feel bad picking on PSE&G, but just so while we're talking about this, basically public policy, taxes, and other would be about 5 cents right now. And I think one of the things that New Jersey does is they have this thing called sales and use tax that's embedded in the cost of energy. So in most states, residential customers are exempt from sales tax. And so New Jersey has SUT, which is actually rolled into the line items on the bill. So if you're ever looking at a PSE&G or a JCP&L tariff, they'll show some of the charges with and without sales and use tax. So embedded in here, in addition to public policy charges, is the sales and use tax components. And so if you look at the different trends, and this is nominal costs, their distribution charges have been fairly flat, but their transmission rates have crept up from, in 2012, it was under a penny until about 2014. And now you're getting to about almost 6 cents a kilowatt hour for transmission. And then generation rates, again, even on just a nominal basis, 10 cents in 2010, a little over 9 cents in 2015. And so, on an inflation adjusted basis, the generation looks much more expensive back in 2010. But I think, what you can see with this, this little table here is that, the declining generation prices, it's a function of shale gas and declining wholesale fuel prices, but it's also the fact that the market's competitive, and if you can't run your generator efficiently, you don't survive. And so I think one of the other sort of stories here, in addition to the declining fuel prices, I'd say, is like a very strong tailwind, or maybe an afterburner on a market where you have investors who are, working to run their plants as efficiently as possible. So there's the benefits of competition and also fuel prices. So if you look at an inflation adjusted basis, it's a heck of a lot cheaper to buy New Jersey's default service for supply in 2015 than it was in, the early 2000s or early 2010s. But yeah, public policy would basically be, that in SUT is about 5 cents. And if we were to look at, some of the items and rates that go into that, it would be, items like there's a solar pilot recovery. There was a program called ZEX. So there was a stabilization charge to maintain the nuclear fleets, because they were, potentially at risk when prices were quite low. So zero emission fuel charge, green program, recovery charges, the conservation incentive program. So there's all these different things that we put in the policy bucket because their general, purpose was not for reliable service, but to help implement, a state decarbonization program.
Jim, you've been so spectacular. Thank you for your time. Just as we wrap up, I think you said, so if those public policy charges, if they're 5 cents a kilowatt hour in New Jersey, is the math right that I think you said your average consumer is about 7,000 kilowatt hours a year. So that's about $350 per household of that cost. Am I doing that right?
I think so. Yeah, that sounds simple math. That's about right.
Okay. And then, so as we wrap up, the question for you is, what where do we go from here? Are you getting commissioned to do new studies, or is there like a sequel coming, or like what happens now?
Yeah, there may, I don't want to speak for EPSA or others, but there may be some new information coming out to kind of keep this fresh, because in the time since we've done the study, there's a new capacity auction, and we're really kind of getting into it and kind of a brave new world of power markets with load growth due to not only AI and data centers, but electrification. I've got an electric car and I love it. I'm probably
what kind did you get, Jim? What kind did you get?
I have a Honda Ioniq.
Nice.
The Ioniq 5, and I love it. I traded in a Bolt. I had a Chevy Bolt, which I also really liked, but the Ioniq 5 is really super.
See, now the local Honda dealer, they owe you now, because you just said that Honda dealers all over the world owe you. I mean, Jim Bride is
it's the Honda.
driver.
So actually, my colleague, Jamie Toscas, has a Honda Prologue, and she absolutely loves it. So I could give a plug for the Honda SUV, the electric SUV. But the Honda Ioniq is, I can pull 200 kilowatts when I charge. It's pretty cool. But yeah, so you've got this world where we haven't seen real load growth in over 20 years.
Well, this is tremendous. Well, look, we look forward to doing more things with you. We can't wait to get the feedback from this. This has definitely been one of the more detail oriented. It's because of you, Deborah. You got us going.
I got us in the weeds again.
No, but this was fantastic. Come see us in Houston, Jim, and we'll come see you in Boston.
That sounds great. Thanks for having me.
Yeah, fantastic. We really appreciate it. Thanks, everybody.